Welcome to the Deep Dive, where we take your sources and unpack the most important insights. Today, we're diving deep into Meta Platforms, Inc., the company behind Facebook, Instagram, WhatsApp. We're going to pull apart its business quality, its financial health, the significant risks it's grappling with, and what the future looks like, all based on that stack of analyses and reports you shared with us.
Yeah, the mission for this deep dive is to really get past the headlines and understand what fundamentally matters about this company that touches billions of lives. We've got everything from detailed financial reports and market forecasts to analyses focused on the core business and, even perspectives on customer and employee sentiment. We want to translate all that into clear, actionable takeaways for you.
All right, let's unpack this business then. Where does Meta even make its money?
It's overwhelmingly from digital advertising. We're talking roughly 98% of their revenue across Facebook, Instagram, WhatsApp, Messenger. That's been incredibly consistent.
And it's not just volume, it's the type of advertising, right?
Yeah.
Highly targeted.
Exactly. The engine behind it is sophisticated AI and machine learning, analyzing user data to place those ads precisely. Then there's the smaller piece, about 1.5% of revenue, Reality Labs. That's their bet on VR hardware like Oculus and, the metaverse.
And that advertising side is just, wow, an earnings machine. Those 2024 numbers were huge. Over $164 billion in revenue and a staggering $69 billion plus in operating income.
Yeah, and that points directly to the high margins you get in digital advertising. Once the platform's built, the cost of showing another ad is minimal. It's a very, very efficient model at scale.
And the model itself, attract users, capture attention, sell access to advertisers, it feels fundamentally tied to human behavior. It seems built to last, doesn't it?
It does. It taps into those basic needs for connection, for sharing, consuming content, particularly video, like we've seen with Reels. And it's riding this huge wave. The global digital advertising market is large and growing significantly. One source forecast, I think, a 15.4% compound annual growth rate to 2033. Another a solid 7% to 2035. That's a serious tailwind.
And AI isn't just for targeting ads anymore. It's becoming critical for adaptation too, right?
Absolutely. AI improves ad efficiency, it helps develop creative tools like generative AI for ads, and crucially, it's developing these proxies to infer user interests as privacy changes limit direct data access. So AI is both how they push forward and how they defend what they already have.
But that deep reliance on user data is also the major flashpoint, isn't it? It feels like the more effective their targeting gets, the more scrutiny they attract.
That's the core tension right there. The effectiveness of their ad model creates this inherent conflict with increasing regulatory pressure and, societal calls for more data privacy. They might have to shift towards, less granular targeting. Adaptation here isn't just about new features. It's about how they anticipate these regulatory and user behavior changes. Think about the Instagram and WhatsApp acquisitions. Those were brilliant historical examples of capturing the next big thing in communication. The metaverse is another attempt. Failing to adapt to these shifts is a major risk to the fundamental business.
Okay, so how does Meta protect this incredibly profitable core? What's their competitive fortress, their economic moat?
Well, the primary moat is just incredibly powerful network effects. Look at the scale. 3.98 billion monthly active people across their apps early this year.
Wow, that's almost half the world's population connected within their ecosystem.
Exactly. And the value for you increases as more of your friends, family, businesses, creators are on the platform. It creates this self-reinforcing loop. It's incredibly hard for a competitor to replicate that social graph. Why switch when everyone you know is already here? That effort to rebuild your network is a huge barrier, something even their own Threads app is grappling with.
And beyond just the sheer number of people, they also have significant intangible assets, right?
Definitely. The globally recognized brands, Facebook, Instagram, WhatsApp, are huge in themselves. And then there's decades of accumulated user data combined with their sophisticated proprietary AI algorithms. That data moat is what fuels the hyper-targeted advertising that advertisers are willing to pay a premium for.
And the sources show that premium in their ability to raise ad prices.
Precisely. A 14% increase in average price per ad year over year in Q4 2024, 10% for the full year. Advertisers pay up for that unparalleled reach and targeting derived from the network and, the data.
So is this moat getting stronger or are their forces eroding it? What's the trajectory?
It's stable, but under significant pressure. Factors potentially strengthening it include their massive AI investments, which aim to boost engagement and ad effectiveness, and continued user growth, even if it's in lower revenue markets. Zuckerberg even mentioned Meta AI is getting huge usage, but the pressures threatening it are substantial.
Like regulation, that seems to be the big one.
Huge. Antitrust actions, potentially forcing breakups of Instagram or WhatsApp, which the FTC is actively pursuing, stricter data privacy laws limiting what data they can actually use for targeting. But then there's intense competition, especially from platforms like TikTok, which is really capturing younger users' attention. And even internal user issues, things like fatigue, misinformation, privacy concerns, the whole debate around societal impact or mental health could slowly chip away at engagement and the network effect over time.
The power really seems to lie in the ecosystem working together, doesn't it? Not just standalone apps.
Yeah, it absolutely does. The synergy is critical. WhatsApp for messaging, Instagram for visuals, Facebook for community, they feed each other, sharing data that enhances the whole system. Regulatory breakups aren't just about splitting assets. They're kind of existential because they fragment this synergy and the data advantage. And as privacy rules tighten, AI's ability to infer preferences becomes the main defense mechanism for that targeted advertising moat. That's why the AI investment is so central to preserving the moat. Historically, they defended the moat by buying potential competitors like Instagram and WhatsApp, but that pathway is largely closed now due to antitrust scrutiny.
So the moat is strong, but it's in a very dynamic state, almost like a constant battle.
Precisely. Innovation and investment battling significant external threats. It's a continuous push and pull.
Let's shift gears a bit from the business model and look at something more human. How do customers and even employees feel about Meta? Let's do a little scuttlebutt simulation.
Right. This gives us that ground-up perspective beyond just the numbers, and customer sentiment is really mixed and very platform-specific.
WhatsApp seems like the golden child in the family.
Generally, yes. Users value its simplicity, its reliability, and particularly the end-to-end encryption for privacy. And crucially, it's ad-free, which comes up as a big positive in the sources. Complaints are pretty minor, like occasional quality issues or missing niche features.
Instagram is popular too, especially Reels for entertainment, right?
Right. It's seen as great for connection, community, and Reels is performing well in terms of engagement. A significant number of users, 44% in one source, apparently use it for product discovery. It has a decent customer satisfaction score too.
But Facebook seems to be where the real pain points are showing up.
Definitely. I mean, it's still the largest network, incredibly sticky with high daily activity, but the complaints are widespread. Inconsistent content moderation, removing valid posts while allowing scams or sort of brain rot content, excessive ads, really unhelpful customer service, particularly for businesses dealing with fake reviews. The perception overall is that the user experience, specifically around moderation and support, has deteriorated.
So there's this kind of dichotomy. People need the platforms because their networks are there, hence the nearly 4 billion active users. But it's not necessarily a relationship built on love or deep trust, particularly with Facebook.
That's the crucial insight from the sentiment data, I think. High utility and even dependency coexist with real distrust over privacy, content moderation, and the perceived societal impact. Engagement might stem more from, captive networks than pure delight. And importantly, problems on Facebook can spill over and potentially damage the overall Meta brand.
What about internally? How do employees feel, especially after that whole year of efficiency?
That's also a mixed and evolving picture.
Yeah.
Historically, Meta attracted top talent with, high pay, great perks, smart colleagues, a sense of mission. And reviews still rate pay, happiness, and benefits highly.
But the layoffs in March 2023 seem to have really shifted things for many people.
They had a significant impact, according to the sources. Reviews mention the layoffs feeling cold or soulless, leading to increased work pressure, a feeling of being just a number, and a more cutthroat or bureaucratic culture. A recurring theme in the feedback is a perceived lack of company loyalty towards its employees. Leadership and management are cited as areas needing improvement. Some employees even feel their skills might be less transferable now, which is a concerning potential side effect.
So while the efficiency drive clearly boosted the financials, it might have come at a real cultural cost.
That's the potential unintended consequence, yeah. If it fosters fear or erodes loyalty, it could shift the culture from being dynamic and empowering to something more risk-averse. For a company banking on big innovation in AI and new platforms, compromising that innovative culture is a critical impediment. Attracting and retaining top AI talent, which is essential for their growth engine, could become harder if the company is perceived as unstable or unsupportive internally.
Okay, let's look at management now and the company's finances. Mark Zuckerberg has been at the helm forever, right? What does his leadership style tell us about Meta's path?
Well, he's known for a profound, very long-term vision. He's willing to make these multi-decade bets like the metaverse or pouring billions into AI, often despite market skepticism. His stated goal is building the future of human connection, focusing on innovation. He wants Meta AI to be a leading assistant. He's also a big proponent of open sourcing tech like PyTorch.
The year of efficiency, though, that felt like a bit of a reaction to market skepticism about that long-term vision, especially the huge metaverse spending.
It did seem that way. Initiated back in March 2023, the stated aim was to make the company leaner, more technical, to improve business performance and, well, support that long-term vision. It involves significant headcount reductions and flattening the organizational structure.
And his control over the company is substantial, isn't it?
Oh yes, via dual-class shares and proxies. That gives him the ability to pursue those large, uncertain bets insulated from short-term market pressure. It's a clear, owner-oriented mindset. That said, the efficiency drive and the recent dividend initiation show he's not entirely unresponsive to shareholder value concerns, perhaps nudged or accelerated by market feedback.
But that concentration of control is also a potential risk, surely.
Absolutely. If his vision turns out to be flawed, that level of control means there's a significant risk of substantial capital misallocation without the typical checks and balances you'd see elsewhere.
So how is Meta deploying its capital these days? What's the strategy?
It looks like a dual strategy. Heavily fortifying the core business and investing massively in future growth engines. Reinvestment in R&D and Capex is huge and increasing. R&D was nearly $38.5 billion in 2023, almost $44 billion in 2024. Capex hit $39.2 billion in 2024, and it's projected at $65 billion for 2025. That's a staggering number, mostly going towards AI infrastructure. Historically, this kind of reinvestment yielded strong returns. The critical question now is the return effectiveness of the current AI and Reality Labs investments. Early signs suggest the AI is helping the ad systems, at least.
Their acquisition strategy was historically transformative, wasn't it? Instagram, WhatsApp.
Hugely value accretive. Instagram for $1 billion back in 2012, WhatsApp for around $19 billion in 2014. They expanded reach, strengthened the moat, and neutralized competitors. Brilliant moves looking back. But recent M&A is heavily restricted due to regulatory scrutiny, particularly that killer acquisitions argument regulators are focused on. That door seems mostly closed now.
And what about returning money to shareholders?
They've returned significant capital through large share buybacks. Something like $91 billion between 2017 and 2022, another $29.75 billion in 2024. While the timing of some past buybacks was debated, buying high, it's generally seen as shareholder-friendly behavior when the stock is perceived as undervalued. And notably, they initiated a dividend recently.
That's a recent and pretty significant move for them.
Yes, 750 cents quarterly, totaling over $5 billion in 2024, yielding around 0.3% annually. Initiating a dividend signals perhaps a maturing business and a commitment to returning capital. It could potentially broaden their investor appeal. Buybacks, of course, reduce the share count and boost EPS.
Does their capital allocation look rational overall, then?
It largely leans rational, I'd say. Investing in the core, especially AI for ads, the historical value accretive M&A, the efficiency drives, and now shareholder returns. The massive AI R&D is a rational bet if it pays off. But the scale and initial sort of opacity of the Reality Labs metaverse spending definitely raise valid concerns about potential empire building or maybe a lack of discipline, amplified by Zuckerberg's control.
The efficiency year and the dividend feel like a recalibration, maybe in response to that skepticism.
I agree. They suggest an adaptive approach, perhaps driven partly by market feedback on the Reality Labs spend, towards demonstrating value while still pursuing that long-term vision. Zuckerberg's control enables those big swings, you see. They can lead to breakthroughs or potentially destruction if the vision or execution falters. The efficiency drive seems like a pragmatic move to reassure investors while those long-term bets mature. They used to reinvest almost everything. Now, buybacks and dividends show they can fund huge growth investments and return cash, which is characteristic of a maturing company where hypergrowth might be moderating. This could attract new types of investors and maybe impose some market discipline on spending. But look, the dividend is still small. Growth is clearly the main priority.
Financially, the sources consistently describe Meta as a fortress. What exactly makes it a financial fortress?
It means it's basically an earnings machine with incredibly strong profitability. Revenue grew from, $86 billion in 2020 to over $164 billion in 2024. Net income is similarly robust, hitting over $62 billion in 2024, recovering strongly from that dip in 2022.
And those high margins are key to that fortress idea.
Absolutely. Operating margin was 42.2% in 2024. This is purely driven by the high-margin advertising business. Reality Labs is right now a significant cost center, dragging that down.
Looking at key quality ratios like return on invested capital, ROIC, that tells us how effectively they use capital, right?
And Meta's ROIC is exceptionally high. Calculations based on the data put it around 39.7% in 2024. That's far, far above any reasonable estimate of their cost of capital, which is maybe 12%. It indicates a superior business model that creates immense value. It's really the financial manifestation of those powerful network effects and intangible assets we talked about. Scaling the platforms has very low incremental cost. The challenge, though, is maintaining this high ROIC with those massive, uncertain AI and Reality Labs investments.
And free cash flow conversion. How well do profits actually turn into spendable cash?
Very strong. Around 83.5% in 2024. It was even over 112% in 2023. They convert net income into cash they can actually use incredibly effectively.
And the balance sheet strength itself?
Outstanding. Looking at net debt to EBITDA, they're negative, around negative 2.33x in 2024. They have significantly more cash and marketable securities than debt, effectively non-existent net debt. This provides a huge safety margin and enormous financial flexibility to invest, pursue acquisitions if regulators allow, or return capital. It's a major competitive advantage that underpins their ability to weather downturns and make those bold, long-term bets.
Okay, so we have this incredibly profitable business with the powerful moat, outstanding financials, but it's facing significant challenges with user and employee sentiment and making these huge long-term bets. What does this all mean for the stock price today? How does the price stack up against the value?
Well, based on the data at the time of the analyses we looked at, the trailing 12-month PE ratio was around 25.26x, and the price to free cash flow was around 31.3x, using the $1.63 trillion market cap and 2024 FCF figures. Of course, these multiples change constantly, and you need to compare them to historical averages for a live assessment, which wasn't fully detailed in the sources, but is crucial.
Right. But given the quality of the business we've described, the wide moat, profitability, financial fortress, dominant position, strong recent growth, how do those valuation levels look just directionally?
My judgment, based on those factors, is that these multiples, PE around 25x, PFCF around 31x, appear potentially attractive, maybe leaning towards fair value for a long-term investor.
Right.
They're not excessively demanding for a company with these demonstrated qualities.
But there's a big if tied to that assessment, isn't there?
Absolutely. The attractiveness is highly contingent on Meta successfully navigating the significant regulatory risks and executing well on its AI investments. If those major risks materialize severely, then the current price might not offer a sufficient margin of safety. The stock has seen a significant re-rating lately, likely driven by renewed confidence in their AI capabilities and, the positive impact of the year of efficiency on margins. So, investors are partially pricing in AI success already. If the AI impact is less substantial or slower than hoped, the valuation could be vulnerable.
So the wonderful company qualities provide valuation support, but that persistent regulatory overhang acts like a ceiling on the multiple.
Exactly. The market pays a premium for quality and compounding potential, and the new dividend might attract some quality or yield investors, potentially providing a bit of a floor. But the significant regulatory risk absolutely acts as a discount. A positive resolution could lead to an upward re-rating. Escalating actions would definitely compress the multiples further.
Okay, let's talk about what drives future growth and maybe more importantly, the permanent risks that could truly damage the business long term. What's the single most important engine for future earnings growth?
Oh, without question, it's artificial intelligence. AI integration and monetization across the entire business is paramount.
How exactly will AI drive growth? What are the key areas?
Well, multiple ways. First, enhancing advertising, improving targeting, personalization, measurement, which is crucial in this increasingly privacy-conscious landscape. Also, deploying generative AI for ad creatives. Second, new AI product services, things like consumer AI assistants. Zuckerberg's ambition is for Meta AI to be a leading player there and potentially enterprise AI opportunities through their Llama models. And third, improved user engagement, using AI-driven content recommendations, like with Reels, to increase the time people spend on the platforms, which in turn expands the ad inventory.
And AI is also their main defense against losing data access from privacy rules, right?
It's critical. As direct data tracking gets limited by regulations or platform changes like Apple's, AI's ability to infer user intent and preferences becomes absolutely vital for preserving targeted advertising. The stakes for AI success are incredibly high for future-proofing their core business model.
Now, the flip side, the genuine long-term risks that could cause permanent damage to Meta. What are the biggest ones lurking out there?
The most potent threat, I think, is severe regulatory action leading to structural changes. We're talking about government-mandated breakups, like being forced to divest Instagram or WhatsApp, which the FTC is actively seeking, or new, very strict regulations that essentially cripple their data collection and targeted advertising model, things like strict opt-in requirements globally, or even outright bans on behavioral targeting. A forced breakup would shatter the synergy and data advantages of the ecosystem. Severe data restrictions would undermine ad effectiveness, directly hitting revenue per user and growth potential.
What about the risk of just becoming irrelevant, of failing to adapt?
Technological obsolescence or sustained loss of user relevance is another huge one. This means failing to keep up with changing user behavior, communication preferences, or being seriously disrupted by competitors like TikTok, especially with younger audiences. It also includes the risk that their big future bets, AI and the metaverse, simply fail to gain traction or become profitable. A persistent decline in engagement and active users erodes the network effect, reduces ad inventory, and makes them less appealing to advertisers, leading to shrinking revenue and profits over the long term.
And then there's the constant underlying issue of trust and brand reputation.
This is critical, and it's interconnected with everything else. Continued controversies, privacy breaches, misinformation spreading, content moderation failures, especially around things like child safety or mental health impacts. Ethical concerns with AI could lead to irreparable damage to trust. A substantial and sustained loss of trust from users, advertisers, and regulators could trigger user exodus, advertiser boycotts, and even stricter regulation, permanently impairing their ability to earn and grow.
Those risks really do feed into each other, don't they? It's not just one thing.
Exactly. Failing at content moderation, for example, diminishes user trust, potentially reducing engagement, which then invites harsher regulation. Unethical AI use could trigger trust issues and lead to AI-specific regulation down the line. It requires a really holistic approach to governance, innovation, and engagement. And look, don't forget, Reality Labs' metaverse, billions are invested there. If it fails over the next decade, it's a huge accumulated financial loss and opportunity cost, even if the core business survives. Success offers a massive potential growth vector, but it's a high-variance, long-duration bet.
Let's try some second-level thinking now. What's the general market narrative around Meta right now, and what might be the less obvious, perhaps underappreciated angles?
Well, the prevailing market narrative seems to be one of cautious optimism. It acknowledges the past stumbles, for sure, but generally focuses on the positives.
Like their AI capabilities and the impact of that efficiency drive.
Yes, there's a strong belief in AI boosting ads and creating new opportunities. The cost-cutting and layoffs improving margins and profitability have been very well received by the market. The core ad business has shown remarkable resilience and growth despite headwinds. Its market share remains dominant. The recent commitment to shareholder returns via the dividend and buybacks is seen as positive signs of a maturing company returning capital. Regulatory risks are definitely acknowledged, but arguably partially discounted. The market doesn't seem to be pricing in an imminent existential catastrophe, perhaps anticipating settlements or manageable adjustments. And the metaverse, well, it's mostly seen as a very long-term speculative bet, less relevant to near-term valuation than AI or core performance.
Okay, so what might the market be missing or underestimating? Where could a contrarian view find some footing?
I think the potential severity of regulatory risk is one area. The political will and the legal arguments for truly drastic actions, like a forced breakup of Instagram and WhatsApp, might be stronger than the market currently believes. The FTC's argument about past killer acquisitions is potent. Given Meta's sheer scale and data collection practices, it's kind of a perpetual target. A manageable outcome by market standards could still significantly cap long-term growth in ways perhaps not fully discounted. Another angle is the secular erosion of trust, the cumulative impact of years of privacy issues, content moderation failures, the whole surveillance advertising label, could be causing a slow, steady erosion of user trust and willingness to share data, particularly among younger demographics. The current strong performance might be masking this subtle long-term threat, making the network effect potentially more brittle over 10 or 20 years than it appears today.
And the cultural cost of the year of efficiency we discussed earlier.
Right. While it was applauded for the short-term financial gains, the layoffs and the potential creation of a fear-based culture could stifle the bold, risk-taking innovation needed for true AI leadership and developing successful new platforms. Short-term efficiency might compromise long-term innovative capacity.
Are there maybe second-order risks from AI itself that the market isn't focused on?
Potentially. Market optimism about Meta's AI might not fully factor in the broader societal risks of powerful AI controlled by just a few large entities, things like bias, misuse, job displacement, widespread misinformation. This could trigger a new wave of AI-specific regulation or a societal backlash, maybe an AI winter, for the industry, which would directly impact Meta's primary growth engine. And while the market largely sidelines the metaverse now, Zuckerberg is still clearly committed. Long-term investors have to factor in the potential outcomes there, either a huge capital sink or a massive upside. The market might simply be underpricing the tail risk of regulators not backing down and pursuing genuinely disruptive structural changes.
Okay, let's try the red team challenge. If the bull case rests on, say, dominant network effects, a highly profitable AI-enhanced ad engine, and a fortress balance sheet, how do we challenge those pillars directly? Let's invert it.
Okay, let's flip the script. To challenge dominant network effects, we'd argue that the dominance is actually brittle and aging. Facebook's core user base is getting older demonstrably, and younger users strongly prefer competitors like TikTok. Trust erosion from platform issues, privacy, moderation failures could make that network stickiness diminish over time. And critically, a regulatory breakup would directly fragment and significantly weaken the network effects for the standalone parts. Now, to challenge the highly profitable ad engine AI enhancement, we'd argue that AI may not be enough to fully counteract the data loss from increasing privacy rules and platform changes. Regulations could become even more stringent, making AI targeting less effective than hoped. This could lead to declining revenue per user and decelerating growth. Also remember, competitors like Google are also using AI heavily. Meta's AI edge might just become the minimum cost of doing business, not a persistent differentiator driving superior margins. And finally, to challenge the fortress balance sheet and capital discipline, we'd argue that the efficiency drive, while financially positive short-term, could hurt long-term innovation if key talent leaves or the culture becomes too risk-averse. The capital supposedly saved might just get poured into the persistently unprofitable Reality Labs division without generating meaningful returns. And the dividend, while nice for shareholders today, could signal that management sees fewer high-return reinvestment opportunities at scale for the core business, which isn't exactly a long-term growth positive signal.
Wow, okay. Given all of that, the strengths, the risks, the different perspectives, what's the most compelling argument for why an investment in Meta today could turn into a major long-term mistake? What's the nightmare scenario?
Well, a significant long-term mistake would stem from a scenario where the core investment thesis that Meta successfully navigates its existential risks and executes brilliantly on AI simply doesn't play out. The risk of a major mistake is the convergence of several critical negative factors, essentially a perfect storm scenario.
What would that look like? What happens in that storm?
It would involve, first, a decisive regulatory guillotine, maybe a court-ordered breakup of Instagram, shattering the core network moat and data advantages. At the same time, new stringent global privacy rules truly cripple targeted advertising, leading to a structural, permanent decline in the ad revenue potential of whatever assets remain. Simultaneously, the AI arms race leads to commoditization and margin pressure. The billions Meta spends on AI don't yield a significant lasting competitive edge because competitors keep pace. AI becomes just table stakes, failing to drive superior ad growth or viable new businesses, while those massive AI infrastructure costs compress margins significantly. Added to this is a sustained user trust and engagement decline. Persistent platform issues, misinformation, scams, harmful content combined with a growing societal backlash against surveillance capitalism cause a slow but steady decline in deep user engagement, especially on Facebook. Younger users permanently shift to alternatives they perceive as more authentic or privacy-respecting.
So it's not just one risk materializing, but several compounding at the same time.
Exactly. The outcome of this perfect storm is a fundamentally diminished company. A slower-growing, significantly less profitable, potentially fragmented collection of assets struggling with a damaged brand, weighed down by legacy R&D costs from failed bets like the metaverse, and unable to attract or retain top talent. The current valuation, which assumes successful risk navigation and AI execution, would then look far too high for this diminished version, leading to significant long-term capital destruction. The wonderful company thesis, built on the durability of the moat and profitability, gets invalidated by overwhelming external forces colliding with internal failures to adapt and build trust.
That was a really deep dive into Meta platforms. We've explored its incredibly powerful core business and the moat protecting it, its financial fortress, the very mixed picture from users and employees on the ground, Mark Zuckerberg's long-term vision and capital deployment, and the significant, even existential risks that could derail the whole thing.
Yeah, it's a company of immense strengths, scale, profitability, financial power. But it's clearly facing formidable challenges from regulators, intense competition, and evolving societal expectations about data and platform responsibility. It's incredibly complex.
Understanding these different layers, the business model, the network effects, the balance sheet, the human sentiment, the regulatory landscape, the absolutely central role of AI, really helps build a comprehensive picture of a company that affects billions of lives every day.
And the valuation, as we discussed, appears reasonable if, and it's a big if, they successfully navigate those major risks and truly execute on their AI ambitions. But as we explored, there's a very real, if perhaps lower probability case for significant long-term challenges if that perfect storm scenario were ever to unfold.
And that leaves us with this provocative thought to consider. Given the fundamental tension between Meta's business model relying so heavily on extensive data collection and society's increasing demand for privacy, and considering the mixed user sentiment and the cultural challenges within the company, how durable is that basic human need for connection, as Meta currently facilitates it, against the potential for a competitor to emerge and build similar utility, but with genuinely greater trust, or maybe even a fundamentally different, less data-intensive model? Something to think about.